So good afternoon to everyone. Thanks for joining us today for this webinar. And I'm Dhaval Kapadia. I look after the investment management for Morningstar out here in India. And I'm pleased to introduce my colleague out here, James, who will be leading the presentation today. James heads the research for our investment management group within the APAC region. So essentially, his team is responsible for building views across asset classes and markets, and these views feed into the the multi-asset strategies that are managed across the region. In fact, he and his team play a role in the strategies that we manage in India as well. I just believe there is some message coming up with an audio problem. I don't know, is that the issue?
No, the audio is absolutely fine.
Okay, wonderful. So, just to sort of, kickstart the discussion, and before I hand over to James, obviously, since the lows of March 2020, we've seen a sharp recovery in equity markets across the world, including in India, probably barring, Chinese equities, which have to an extent moved in the other direction. But most of the other markets have been driven, one is by since you had the vaccine discovery happen, that sort of helped markets, as well as a strong recovery in the economy, which has been sort of propped up by low interest rates and sort of easy sort of fiscal kind of measures as such. And so that's what has been driving markets and the economy as such across the world. And alongside this, we've also seen supply side issues crop up, right? And you would have heard of this quite often over the last few months in particular, whether it is a supply of commodities or logistics issues. These have cropped up over the last few months in particular, and these have in a way resulted in inflation moving up in most countries, and particularly developed markets. And as we know, and I'm sure James is going to talk more about it, but in the US, obviously, we've seen inflation, which is unseen for the last about 3 to 4 decades as such. So from that perspective, when we look at it from an investor's point of view, they're facing multiple challenges today. One is how do you beat inflation in a low but rising kind of an interest rate scenario, and how do you deal with high market valuations? With the way markets have recovered, valuations have definitely moved up. So, how do you deal with these kind of scenarios, and what sort of stand should investors take? So, to share his perspectives, obviously, I'll hand over to James, to talk about his thoughts. And just before we move to that, a couple of sort of housekeeping points very quickly is that, obviously, we love to engage with you, and we'd love to hear your questions. So please use the Q&A tab that you'll see at the bottom of your screen, rather than the chat box as such. That way, we can make sure that we try and get to as many questions as possible. And towards the end of the survey, towards the end of the webinar, we'll have a short exit survey, and we'd love to hear your feedback. So do make sure you complete that survey towards the end of the webinar. So with that, over to you, James.
Well, thanks very much, Dhaval, and good afternoon, everybody. It's wonderful to be here, particularly at such an exciting time for markets with all that's going on around the world and within India as well. So today I'm going to start by talking firstly about the evolution of our process. That's important because our process guides how we think, it guides how we ultimately invest. Now, our valuation-driven asset allocation process was developed here in Asia Pacific over 10 years ago by Daniel Needham, who's now the global president of Morningstar Investment Management. But the reality is that Morningstar has decades of thought leadership. And these 4 papers that you can see on the screen, they really track the thought leadership upon which our process is built. And it goes all the way back to 1976 with the publication of the year-by-year account of the returns produced by stocks, bonds, bills, and inflation, SBBI. And that publication was written by Roger Ibbotson and Rex Singerfield. Now, all good research is based on good data, and the SBBI yearbook was the gold standard. Then there were a series of papers that really explored the fundamental drivers of asset price returns. Now, these papers are sometimes referred to as what are known as the supply side papers. And they argued that equity markets will be driven by fundamental factors like earnings growth and inflation. They also argued that these factors will be tied to the overall performance of the underlying economy. Now that makes sense because companies obviously sit as part of the economy, so earnings will be heavily tied to the economy's overall performance. That's the underlying premise behind the supply side papers. Then in 2017, a paper by the name of The Long Run Drivers of Stock Returns, Total Payouts in the Real Economy, was published by Roger Ibbotson and Philip Strahl. Philip's our global head of research. And as part of that paper, we saw the integration of buybacks into models and effectively expanded the direction of research towards incorporating not just dividends, but payouts in the context of buybacks. And the best way really to showcase some of these concepts is through an example. I'm going to give two examples today, but the first goes back to 1871. Now, the framework we use to create our capital market assumptions is built on a building block concept. And it's more than just a theory. It's a coherent way really to explain history and to think about how markets could perform into the future. Now, this chart, as I mentioned, goes all the way back to 1871. It tracks the performance for the US equity market, the S&P 500. And this data set goes more than 50 years back than the SBBI data. So we've got a fairly representative time frame here. What I can tell you is that over this time frame, US shares produced an annual return of 9.2%. Now, what's most interesting about this is that most of this 9.2% can be explained by underlying fundamentals. Now, by fundamentals, I mean those components, those building blocks underneath. At the bottom, you have inflation in maroon, in red. And over the full period from 1871 through to 2020, inflation in the United States averaged 2.1%. Above that, in green, we have the total payout yield. That includes buybacks, that includes dividends. And over the whole duration, the total payout yield averaged 4.8%. And then finally, in yellow, we have growth, the cash flow growth. And over the period, the full period, cash flows grew by 1.6% per annum. Now, taken together, these components add up to an amount that's only slightly below the total return produced by the market. So what this means is that over the extreme long term, and this is the extreme long term, no doubt about it, but over the long term, markets do a very good job at efficiently tracking fundamentals. But there is one more building block, and that's valuation. This is the framework that we use to create what we call valuation implied returns, VIRs. Now, valuation does not matter for periods spanning almost 150 years. We just showed that. But it certainly can have a big impact on returns for periods spanning 5 years and even 10 years. And we're going to have a look at an example in a moment of why valuation matters. Now, our process, it carefully integrates the building blocks that you can see here across equities, across property, across bonds, and across currency. What you can see at the top are the common components across each of these assets that we look at, including cash flow yield, the growth in that cash flow, and then finally the change in valuation. Also, we add to these building blocks our expectations for inflation. Now, we use our valuation implied returns, again, our VIRs, to ultimately inform what we call our conviction scores. Our conviction scores encapsulate what we think of an asset class and ultimately whether or not we think it represents good or bad value. Now, our conviction scores are made up of 4 pillars. The first pillar is shown there on the left, absolute valuation. The question we're asking ourselves in answering this is the asset class cheap relative to its own history? Or ultimately, is it cheap compared to what we'd expect from this asset class in the long term? The next pillar considers relative valuation. Is the asset class cheap in comparison to other similar assets? And by similar, we mean on a risk-adjusted basis. Next, we can consider, or we do consider, contrarian indicators. These are important. What we're looking at here is for evidence of extreme investor optimism or pessimism. So we'll look at earnings expectations. Is the consensus bullish or bearish? We'll look at flows. Have there been abnormally high or low flows into an asset class? Has performance been abnormally high or low? These are signs and signals we use to assess the contrarian indicators. Ultimately, we're looking for an unloved, under-owned asset. Then finally, fundamentals. Here we're looking at the potential for a permanent loss of capital. And we'll talk a little bit about what this means later in the session. Now, I want to go through an example of how a building block approach can help break down outcomes that have occurred in the past and then act as a framework to think about future return scenarios. And we're going to do that, or we're going to do this with 2 market indices. We're going to look at the MSCI Large Growth Index. We're going to also look at the MSCI Large Value Index. So first up, we're going to look at the 7 years to the end of last year. So 7 years to the end of the 31st of December, 2021. Then, or in a moment, we're going to look at some scenarios for the next 7 years from that point for these 2 market indexes. Now, the biggest constituent or the biggest companies in the MSCI All Country World Large Cap Growth Index, they include companies like Apple, Microsoft, Amazon, as well as Tesla. From a sector perspective, the biggest components include big IT, consumer discretionary, as well as communication services. I can also tell you that the United States makes up around about 63% of the MSCI Large Cap Growth Index. Now, the MSCI All Country Large Cap Value Index, on the other hand, is a little bit more disparate, a little bit more spread out, less dominated by any one particular set of securities or sectors. But it does include some of the big US banks like JP Morgan, as well as Bank of America. In fact, financials are the largest sector within that index. They make up at the moment around 24%. Now, what this shows is that the last 7 years for value have been tough, very tough. Annual earnings growth only amounted to 3.4% per annum over that 7-year period. And that was well below its 25-year average. Over the last 25-year average, that index has provided earnings growth in the vicinity of 4.5%. So it was an unusually subdued period for value. In contrast, you can see the large cap growth index saw its earnings increase by 6.75% per annum, that building block there in blue. And that was slightly above its 25-year average for growth. That 25-year average was about 6%. Now, in addition to that fundamental earnings growth, what you saw in the case of large cap growth was multiple expansion. And that multiple expansion, so in other words, PEs rising and increasing, it rising over the start to the end, that added an additional 7.3% per annum to returns. And then finally, over that time frame, dividends gave investors around about 1.5%. In contrast, values barely saw anything from multiple expansion, just 1% per annum. But dividends, at least, provided around about, as you can see, 3.5% per annum. So all in all, large value returned 8.1% over that time frame, and large growth provided a return of 16.2%. And it really gives a sense, I think, for how extraordinary a period it has been for large growth over the last 7 years, and in particular in recent times over the last couple of years. Now, this analysis, as I mentioned, and as you can see, is to the end of December. Since then, over the course of January and into this month, value has been very strong. I first started to put this analysis together at the end of last year and updated it since. And it's amazing how quickly it started to play out. But the point really that we wanted to show you, the reason why we're showing you this is to really break down and help you identify how asset class returns can be broken down into their building blocks, and then use that analysis to build up scenarios for the future. Now, you can see here exactly what happened or what has happened with regards to PE ratios in the period to the end of December. Once again, large cap growth is in green, large cap value is in orange. Now, the MSCI large cap growth price to earnings multiple started out at 21 times in December of 2014. It ended the period at just under 35 times at the end of December 21. So that 35 times is well above the 7-year median multiple. In contrast, the MSCI large value price to earnings multiple, as you can see, barely increased over that 7-year time frame. It rose from 14 at the start to end at 15. That 15 is slightly below the 7-year median multiple, which is around 15.5 times. This chart really gives a sense for how extraordinary a period it was for large growth, again, particularly in recent times. So let's now do an exercise to break down and analyze some potential scenarios for the next 7 years from the start of this year. Now, to keep it simple, we're going to just look at 4 scenarios. This is not exhaustive. But what we're going to do here is look at the impact of 4 different ending PE multiples. So, for example, if PE multiples grow from 10 and end at 20, then all else being equal, the return contribution from PEs expanding will be 100%. Now, on top of that, you get dividends together with any growth in earnings that include buybacks. So what we're going to do as part of this is assume that dividends over the next 7 years are equal to the current yield. And that's about 0.4 or about 0.7% for growth and about 2.8% yield for value. The next thing we have to think about is earnings growth. Now, the number that we've included here is simple. What we've done is looked at history, and we've weighted that history more heavily to the last 7 years. Again, that last 7 years was very good for growth. So this simple analysis is quite kind to growth. And again, it's not so good for value because over that time frame, as I mentioned, value hasn't kept pace with its long-term average. Now, really what we want to do, as I mentioned, is look at the impact of different PE multiples. Again, 4 scenarios. In the first scenario, we're going to assume the multiple remains unchanged. So it starts at 34.76 for growth and ends there after 7 years. Now, already what I can tell you, in fact, in the month of January to the end of January, that multiple has started to come down. So already scenario one is looking less likely. We're looking at large growth multiples having moved down to around about 32 times. Now in scenario two, we assume the end multiple in 7 years sits on the edge of the top quartile of multiples for the last 7 years. So the top quartile of multiples for the last 7 years, that means around 28 times for growth and around 17 times for value. Now in scenario three, the assumption there is that multiples move back to the median over the last 7 years. And we just saw those medians a moment ago, the 24 times for growth, 15.5 times for value. And then finally in scenario four, we look at the impact of moving back to a median multiple over the last 25 years. And you can see in each scenario, those multiples are moving down and becoming a little bit more conservative. So let's look at the effect of rolling these building blocks up into a series of total return expectations and scenarios for large cap value and large cap growth. Now, investing is all about probability. And that's what we're trying to convey through doing this work. Again, we're making the overly simplistic assumption that there are only 4 scenarios. But you can see that there's only one scenario where growth outperforms value, and that's in scenario one, again, where multiples stay unchanged from those levels at the end of December last year. Now, I can tell you that that multiple of 35 times for growth, it sits in the top quintile, the top 20% of multiples over the last 25 years. So in other words, you need to assume that multiples remain at those elevated levels for growth for the full 7 years for growth to win. In fact, we can look at these 4 scenarios and ask ourselves, what level of confidence do we need to ascribe or put on scenario one for growth to beat value on a probability weighted basis? Well, I can tell you that on a probability weighted basis for growth to beat value, you need to put an 88% probability on scenario one for growth to win. 88% probability on scenario one. Now, again, this analysis was done to the end of December. Since then, there's been an element of this already playing out. In fact, over the month of January, large value outperformed growth by some 7.5%. So what that means is once you take that into account, going forward, the return expectations for value compared to growth are about 0.8% less than what you're seeing here. Nonetheless, the quantum and the direction absolutely, the direction, if not the quantum, absolutely holds. So let's move on to the investment environment and some possible strategies to apply in what we think is going to be a lower return environment going forward. First up, we want to look at how we got to where we are today. And this chart tracks 10-year government bond yields for a number of countries, including India. But I want to focus on the United States in particular. We started the century with 10-year bond yields in the US at around 6%. Now, since then, we've had a multitude of market events, such as the global financial crisis, taper tantrums, serious Fed tightening, as well as COVID. And throughout all of those events, we saw US bond yields and bond yields all around the world move around. And each time those bond yields moved around, the impact reverberated around the world and into equity markets. Now, it's worth noting too that Indian bond yields have moved down, but not to the same extent over the full time frame. In fact, most of the move down in Indian bond yields on this chart occurred between 2000 and 2004. But no doubt, over the last 2 decades, falling global bond yields have fueled asset class booms all around the world. And there are, of course, limitations to how far this trend for ever decreasing bond yields can continue. And the start of this year really has shown just how quickly things can change. In the space of 6 weeks, the US 10-year Treasury has moved up by 0.5% from around 1.5% at the end of December last year to just over 2% today. Now, in terms of equity markets, this chart shows the investment growth of a number of market indices, including the BSE 500 for India, the S&P 500 for the United States, MSCI EM Index, Morningstar's Developed Market Index, as well as the MSCI All Country World Index. The last 5 years are shown on the left-hand side, and the last 10 years are shown on the right-hand side in terms of cumulative performance. And really you can see the strength exhibited by markets over both of these timeframes. I think the one exception, though, is the emerging markets. You know, the emerging market index there in red. So particularly more recently, but in general, you can see markets around the world, including those in India, have been very strong. Now, problem-facing markets, we think, unfortunately, the problem is that the easy gains are behind us. You know, we entered 2022 with high valuations, both locally in India and higher valuations abroad within the equity markets. Now, no doubt, the start of this year has seen weakness for key markets like the US, but in general, the picture still remains. And this chart shows the expected returns for the next decade for several asset classes. And the expected returns that you're seeing here are in INR terms, and they include inflation. Now, all up, we think it's going to get a lot harder from here. The reason that these return expectations are lower than normal is because valuations are higher than normal. And so the valuation building block is detracting from forward return expectations. Now, the previous chart I just showed you was for the return picture, but of course, investing involves the risk piece as well. This chart shows our simulated drawdowns for several local and global assets. And these simulations, they call upon our capital market assumptions, including volatility and correlate factors within volatility, as well as our return expectations and valuations. You can get a sense for the relative drawdown potential here of Indian equities as compared to, say, global shares or even short and long-term debt. So in other words, Indian equities have much greater scope for capital loss than some other assets on this slide. No doubt, Indian equities do have that higher drawdown potential. Now, we think the problem
James, if I can just stop for a minute. If you go back to the previous slide, you mentioned here that the potential for drawdown in Indian equities seems to be much higher than most other equity markets worldwide. So, what would be the key sort of reasons for that? I mean,
thanks, Dhaval. Great question.
Yeah.
Thank you very much. So the way we build our simulations for drawdowns involves two key parameters: our expected return and expected volatility. And the volatility that we assume is based on market factors. So we work that out on an annual basis and update that process. But with Indian equities, the volatility is higher. We have a higher expected volatility for Indian equities as compared to, for example, the All Country World Index. And that's what's driving, predominantly that's what's driving that larger drawdown expectation is simply the higher expected variance in returns.
Fair enough. Thanks.
Now, in short, we think the problem confronting investors is that going forward, returns are going to be lower and people will need to carry more risk to generate those lower returns. So what's the answer to this conundrum? What's the answer to this problem? Now, we don't think the answer is any one thing. We don't think there is going to be a silver bullet. It will need to be a combination of strategies, whether it be within fixed income, within currency, or within equities. The other point to note is that the opportunity set will constantly change. It will constantly evolve, and it's critically important to be dynamic. Firstly, inflation on the top left. It's a key piece in the puzzle for any strategy that seeks to build wealth in real terms in the long term. Obviously inflation acts as a tax in that it reduces the real purchasing power of assets. So it matters, and it's also highly topical at the moment. We're going to talk through our view on inflation in a moment. Now, diversification will matter too. Here's where foreign exchange and currency in particular comes into play. Bonds will also have a role to play in regards to diversification. At its core though, ultimately, we think the way forward is to ensure that portfolios are pointed towards the right areas. And in many cases, those right areas won't be consistent with the index. And we know that where the so-called right areas are will constantly change. But we think it's critically important to maximize reward for risk by targeting the most attractive assets. And we think that's the solution ultimately to a low return environment. Now, I want to talk about now the concept of risk, and in particular drawdowns. So we just talked a little bit about how we formulate our drawdowns and how those drawdowns, are comprised of a volatility element and a valuation-driven element. So if an asset's extremely expensive, then the valuation-driven component of the expected drawdown will be quite large. Now, not all drawdowns are equal. There is no such thing, though, as a good drawdown, but some drawdowns are less bad than others. Let me explain.
And
the first
James,
kind of
sorry to interrupt you. Yeah, just before we go out, for the benefit of the audience, can you explain the concept of drawdown a little bit in brief? Before I thought before we go down to the types of drawdowns, maybe it'll be nice if you can just talk a little bit about, because in India, probably most people are used to looking at volatility in terms of standard deviation, right? And not so much in terms of drawdowns. So it'd be useful if you could just talk a little bit about what a drawdown really means or indicates. Yeah.
Thanks very much, Dhaval. Exactly. That's how people think about risk, measured by volatility. And that's fine. But obviously volatility goes both ways. It includes upside, it includes gains, it includes losses. And when it comes to risk, gains are not a risk. Losses are. And that's why we focus on the drawdown, the loss component. So the way we measure the drawdown effectively is from a point in time. If an asset gets to for example, to $10, and then it falls to $5, that would represent a drawdown of 5. Or if it gets to 20 and then falls to 15, again, that would be a drawdown of 5. That is what ultimately, how we think about risk, in that we think about risk in terms of potential for permanent loss of capital. In other words, the potential for a permanent drawdown. Now, one way you can get a permanent drawdown is by paying too much for an asset. So if you buy an asset that's worth 10 and you pay 20 for that rupee, for example, and ultimately it goes back to 10 rupee. Well, that $10, that 10 rupees gone. Gone. It's not coming back. That's a valuation-induced drawdown that is gone. And that is the kind of drawdown that we seek to avoid. They're the worst kind of drawdowns. But ultimately, if an asset just is moving through the cycle and it's oscillating and it goes from 10 to 20 and then back up to 20 and then back to 30 and then back to 20 and back to 10 and then back up to 20, those drawdowns are less bad because that's really just volatility working through, and it's not necessarily permanent. This is a good type of drawdown, a less bad type of drawdown. So the valuation induced ones are the ones we're trying to avoid. Really to highlight what we mean by this, when we talk about volatility induced drawdowns, take a look at this chart here. It shows the expected likely range at a 99% confidence interval for global energy. Why did we choose global energy to show you? Because global energy is cyclical. It's got cash flows that are heavily tied to the economy. So those cash flows are volatile. As a result, global energy is volatile as well. And the range of returns from global energy are wide as a result of that cyclicality. And our modeling shows that the expected return from energy over 1 year spans from minus 53% up to 67%. But by the time you get out 20 years, that return is likely to fall between minus 6 and 21. So it compresses. The longer the time frame, the lower the range. So we have a decent tolerance for holding assets with economically sensitive cash flows, even if those assets have higher core volatility. That's because higher core volatility can be recouped with time. Does that make sense, Dhaval?
Yes, absolutely. I think it does.
So time can be a very valuable friend to reduce the variation in returns. Again, we think about risk as the permanent loss of capital in real terms. As I mentioned, one way permanent loss can occur is if you overpay. And another way though, permanent loss can occur is if there is a structural impairment to cash flows. Now, the best way to mitigate this risk in our mind is through an in-depth fundamental review. This is the fundamental pillar that we spoke to back at the start. Now, we undertake fundamental reviews of assets that are presenting as being attractive when we undertake a deep dive research process. And as part of that fundamental review, we're looking at a number of these categories that you can see on the screen here. So for example, within equities, is the level of gearing higher or lower than normal? So for example, within banks, obviously there's a high level of financial leverage in a bank. We expect that, but is that level of leverage today higher or lower than normal? Leverage is one thing that can cause a permanent loss in capital. Similar story for operating leverage. We'll also look at the potential for there to be technological obsolescence. If those cash flows have the potential to melt away in time, then obviously that's a fundamental risk we want to take account of. We'll also consider material ESG items as part of this analysis. And then there are a number of indicators as well that we consider as for fixed income and currency, and you can see those there on the right. Now, I want to move on to some of the mitigants that I spoke to a moment ago, some of the portfolio diversifiers that can be employed. One of those diversifiers for Indian investors is the US dollar. It tends to behave as a so-called safe haven currency, in periods of broad market distress. Now, by allocating smartly across the currency universe, we can lean on the protective characteristics of the US dollar when it makes sense to do so. Gold is another asset that's known for its safe haven properties, but it doesn't provide the income, it doesn't provide the cash flow that you can get from other potential assets. So in other words, investing some exposure into overseas equities does give you that cash flow, while at the same time, overseas equities give you the potential benefit of providing diversification to the portfolios through foreign exchange. Now, this table shows those protective benefits of currency. You can see in the red box the performance of the Indian stock market during 4 major market drawdowns since 2000. Those drawdowns ranged from minus 58% back in the TMT bubble of 2000, and then which ultimately deflated post 2000. You can see also drawdowns of 63% during the global financial crisis, and then 20% in 2016, and almost 37% in early 2020 at the start of the pandemic. Now, in the next column, we show the MSCI World or Country World Index and how it performed during the same period in Indian rupee terms. And you can see that the drawdowns are much less pronounced. So instead of 58% for 2001, the losses were about 35% for the MSCI World over that same period, materially better during the GFC-induced losses, and better by about 8% for the last two drawdowns. So part of the reason why the drawdowns were less pronounced was because the Indian rupee fell more than the currencies that made up the MSCI World Index. The other reason is because the world markets offer diversification. They offer a spread, and that also helped performance of the MSCI All Country World Index. So for example, in the GFC, the rupee fell about 27% against the US dollar. That meant the losses were much less pronounced. In all four periods, the US dollar rose against the rupee. I've talked a lot about the return environment, but no doubt one key question confronting investors at the moment is inflation. It's so important because it ultimately affects monetary policy, it affects bond yields, ultimately it affects valuations. I'm going to start talking about the US inflationary backdrop and then pivot back to India. Now, really, prior to COVID, the problem with inflation in the United States was its tendency to undershoot. You know, labor market structures, technology, the sharing economy, Uber and Airbnb, they all exerted downward pressure on prices. And what you're seeing here is from the former chairman of the US Federal Reserve. He said this, Alan Greenspan, to Congress back in 2005. Now, what's changed in the last 2 years was the pandemic, where trillions of dollars on stimulus and spending was spent, and saving patterns changed at the same time. You know, the response to COVID by authorities all around the world has been nothing short of enormous. It's been much bigger and much more persistent than previous cycles. The Fed's balance sheet grew by over $4 trillion in less than 2 years. It took 5 years for the balance sheet of the Fed to grow by the same amount post the GFC. Now, more importantly, I'd say that the extremely easy financial conditions in 2021, they were met with substantial fiscal policy post the vaccine rollout. You know, post the GFC in the US, you had a situation where political gridlock kicked in when the unemployment rate was still above 9%. So that left only monetary policy to expand the recovery. This has not been the case this time. You know, the fiscal response has been absolutely supercharged. And so as a result, throughout the last year, you've had a situation where there's been excess savings, dry powder left over. Today's recovery too looks much different than in the past. It's not constrained by the healing of critical sectors like banking or housing or consumer credit. Each of those sectors are much stronger today than post the global financial crisis. So the size of fiscal transfers has been unprecedented. Disposable incomes increased, especially in the US. And at the same time, the pandemic's caused a shift in spending patterns from experiences to products. All that's caused demand to spike. You know, from the perspective of the Fed, they expected that by last year, all of this would have dissipated. There would have been a rotation. People spending more on travel, dining out, moving away from merchandise sales. But Delta, then Omicron, has slowed that transition. It's added to the supply chain pressures that have been occurring throughout the world, and all that's put pressure on prices. That's just the demand piece. Supply has been just as problematic. This is the picture of off the coast of Los Angeles from last year. The Port of LA, I can tell you, as well as Long Beach, it handles about half the Asian imports into the United States. And you know, through the second half of last year, these ports averaged over 40 vessels waiting at anchor off the coast to dock at times, though there were much, much more than 40 vessels. And you can get a sense from it here in this picture. Now, at the same time, there's been wage pressure building in the United States as demand for labor has been rising. Job ads have been increasing massively. So it's been somewhat of a perfect storm. Now, Omicron has elongated the process, but globally and ultimately, we expect the effect of the stimulus to fade eventually. We also expect people to have ultimately pivot back to experiences and travel. We also eventually expect the supply chain disruptions to pass. But and also at the same time, many of the forces that historically put downward pressure on prices remain. So our central case is that hyperinflation is unlikely, but global inflation may be a little bit higher for the foreseeable future. What that means is that portfolios need to be managed to cater to a range of scenarios. Now, in terms of India, obviously similar dynamics at play. It's interesting that inflation in the United States last year was higher than India, but inflation pressure nonetheless has been building in India as well. At least you have a situation where consumer prices remain well within the RBI target range. No doubt the higher weighting to food within that index has helped contain overall prices, but unfortunately, wholesale price growth hasn't been as low. And you can see that on the blue line, the right-hand axis on the chart, raw materials, fuel prices, some of the dynamics here at play pushing prices up. So inflation is something that we're monitoring very closely as part of the portfolios. Now we want to talk about our outlook and views, starting with the concept of divergence. Divergence is something we discuss on an ongoing basis. It's the difference between the assets with the highest expected returns and the assets with the lowest expected return. How big's the spread? So we measure divergence using what we call the margin of superiority. It tracks the difference in expected returns between the top and bottom 20% of assets on the basis of our numbers. Now, back in October of 2020, the level of global divergence reached record levels. Now, that divergence, margin of superiority, has no doubt retraced since then. But in some areas, like the emerging markets, you can see that it remains quite elevated. But the point here really is to show you how divergence changes through time. It's these moves that we want to exploit. So the reward for risk in markets is not constant. It is constantly moving around. It's constantly changing. And it's because of that, we think that an active approach is just so important. We're not set and forget investors. We'll follow opportunities as they're presented. So let's look at the opportunity set. This chart shows the real valuation applied returns to the end of January of this year. Now in blue, you can see those valuation applied returns. And the return for the corresponding year prior, it's in green. Now we've ranked this chart from highest to lowest expected return. Most notable, as you can see on the left, are Chinese shares. Now we think the sell-off in Chinese equities over the course of last year, which was triggered by the regulatory crackdown and some slowing, issues with regards to slowing economy, we think that presents investors with an opportunity to purchase, in particular, shares of big tech companies in China at lower valuations. So in other words, at current prices, China appears to offer better value from both an absolute and a relative sense in comparison to other major markets, even after accounting for the potential impact of the regulatory crackdown and how that may affect growth and profitability. So the other thing to point out is that Chinese stocks have an attractive growth profile, particularly the major tech names. They also have lower financial leverage, and that speaks to their fundamental risk. So we think there's a growing case for investing within China. You can see here too the improvement in the expected return for China over the last year. A year ago, that expected inflation-adjusted return was just 1.5%, but by the end of January, it was almost 7%. UK equities too are reasonable relative value, but unfortunately at the moment, there isn't much that is attractive in an absolute sense. But nonetheless, there are some assets that are more attractive than others. This chart here.
Yeah, sorry, just before you go
Dhaval.
ahead, on the previous slide, can you talk a little bit about, several slides earlier in the earlier part of the presentation, we looked at nominal returns, right, for different asset classes. And now here we're looking at, real returns that we expect, across these asset classes, right? So, what would be the reason to use, real returns? It's a slightly more basic question, but then I thought for the benefit of the audience, if you could just quickly, talk about, why should you compare asset classes based on real returns rather than nominal returns?
Really good question. And the reason why we do that is to have a like-for-like basis for comparison. Now, this does not include currency. It does not include inflation. Like you mentioned, Dhaval, if we were to include inflation as the building block for each of these asset classes, we would have a nominal return. But once we do that, we'd need to include currency as well. Now, obviously, as we do from a portfolio management perspective, we think about it. We think about the return expectation in currency adjusted terms, in INR terms, including inflation. But that's a process where we layer on the return expectations one piece at a time. This is stripping it right back, just to the underlying asset to give us a sense and viewpoint on what the asset's expected to generate, excluding currency.
Fair enough. Thanks.
This chart shows the impact of valuations and effectively the expected returns for the global sectors. And we've split this into the United States or the USA in blue, as well as Europe in green. And again, the picture is rapidly changing. A month ago, European energy was at the top, the most attractive sector on this chart to the far left. But European energy rose 13% over the month of January. It's now third on the list. You can see with it falling to here. And that's now behind financials. It's behind communication services. So communication services, that includes stocks or the big European telco companies, companies like Vodafone, companies like Orange. So we have a situation now where European energy is not the opportunity that it once was, but it still remains okay on a relative basis. One point worth mentioning on energy in the current environment is its fundamental link to inflation. So we talk about the importance of having portfolio diversifiers and different assets in a portfolio to cater to different scenarios. Obviously, oil is a commodity, and any price increases are passed on to consumers. So in the event of a continued rise in inflation, energy does stand to benefit from a fundamental cash flow perspective. And absolutely, you can see that playing out in recent performance. Now, in terms of some of the global conviction scores, this is our latest picture for the global assets. You can note, unfortunately, there are only a few assets that look okay on a relative basis. One of those assets, as I mentioned a moment ago, is the UK, and also parts of the emerging markets that look relatively appealing. And in this category, of course, making up around a third of that emerging market index is China. We're also actually keeping a close eye at the moment on Russia with regards to valuations in the situation unfolding there. Then finally, within fixed income as well, we've obviously had a situation where yields have risen across the world. But in general, we would say that yields still remain low by historical standards, despite the rise that we've seen over the course of this year. Nonetheless, emerging market debt stands out in the fixed income domain at the present time. Now, turning quickly to our view on Indian equities, I think we'd note here again that there are a number of aspects to expected returns. So on the valuation front, you can see on the left-hand slide here that PEs have been high in recent times for Indian equities, but they've been moderating. They've been coming down as earnings recover. So this is the 1-year trailing price to earnings multiple. You get a sense for the recovery and profitability that's been occurring by looking at the chart there on the right. And that chart shows return on equity levels, ROEs, for small, mid, and large cap Indian equities. And you can see the turnaround that started to occur for profitability in Indian equities. And so, we also would point out the market is expecting that profitability to continue. If you look at the chart on the left, it shows corporate profitability in relation to GDP through time, and you can see expectations are for that corporate profitability to start rising again, back to levels where it has been sort of, 10 or so years ago. Expectations for Indian earnings, equity earnings are rising. And that's also playing out in forward price to earnings multiples, where you can see forward PEs, are sitting in the low 20s for Indian equities. So in other words, the market is expecting earnings to rise strongly by 20 or 25% over 2022 to 24. And from a fundamental perspective, that's great. But we would note that fundamental earnings growth is reflected in prices. And to the extent you don't get that fundamental earnings growth coming through, if for some reason the market disappoints, is unable to produce that level of expected earnings growth, then you're likely to see underperformance of Indian equities. And it's that valuation piece, that combination of high multiples and high expected earnings, which sort of moderates our view on Indian equities at the present time. But nonetheless, we certainly recognize the stronger fundamentals for Indian equities, but conscious that valuations are reasonably full at the present time, and that's reflected in the positioning of the portfolios. So let's bring it all together. You can see here the positioning and allocations for the active, aggressive portfolio. And overall Indian equity allocations, I can tell you, are high. They're high in absolute terms, but relative to the benchmark, they're underweight. And the reason why they're underweight is because of our view on Indian equities in terms of their relative appeal. But in aggregate, the aggressive portfolio is about 2% underweight its Indian equity benchmark. So that includes small, medium, and large cap Indian equities, about 2% underweight, but a large absolute exposure nonetheless. US equity exposure is also below its neutral allocation, but the team have been increasing allocations to US shares more recently. So the US exposure has risen by 1.5% over the course of this year, post the falls that occurred throughout January within the US share market. Now, in terms of the overweights, you can see that emerging market equities are overweight. And again, this reflects the positive view on China. But markets like Brazil are also areas that we've been researching, on the basis of their increased appeal. Another area worth calling out is the Indian long-term bond or long-term debt overweight. Again, that's consistent with a favorable view towards those assets. So Dhaval, I've spent way too long. I've gone way over time, and I'm sorry. And I'll wrap up now, but then very happy to take questions. So in summary, we do expect returns to fall. Obviously, returns have been very strong over the last couple. We don't expect that to continue. Our response to that, when presented with this challenge, is to target the most attractive assets. We expect the opportunity set to constantly evolve, to constantly change, and therefore portfolios will need to evolve and change as well, and continually ensure that they're pointed to the most attractive assets. At the same time, ensuring the portfolios are robust to a range of scenarios on inflation and economic growth. And we continue to position portfolios to reflect our forward-looking return expectations. So with that, very happy to take questions, or hand back to you, Dhaval, to make any additional comments.
I think, those are some great perspectives on how investors can deal with, the current environment where, on the one hand, you see inflation move up in many markets, equity valuations being high. So I think you addressed most of those sort of concerns as such. So I think what we can do is quickly try and address a few, questions from our participants as such. And, the first question is around, is it a good time to invest in defensive kind of sectors such as FMCG, which is like fast moving consumer goods? Essentially, is it a good time to invest in consumer defensives going forward, given that future volatility might be a little bit higher than normal?
That's a really good question. So I mentioned before about this concept of portfolio diversification, and we call that currency as one of the diversifiers. And risk mitigants that can be fixed income is another one of those. But within equities, defensive equities play a really important role. And assets that, like those that have more stable cash flows, are very important in that respect. We think, yeah, so the answer is subject to valuation. It's always got to be subject to valuation. Now, we think ultimately, going forward, growth exposures will potentially need to be higher than they have been in the past because return expectations have come down. And now with that higher growth exposure will come more volatility. And for people with short timeframes, that's where mitigants like, staples and assets that are tied to cash flows that are less volatile will become critically important. So the answer is they play a very important role, Dhaval.
I think, another question has been, the US markets have done, as you've pointed out as well in some of the slides, have done very well over the last decade, and they've sort of outperformed Indian markets as well. So, is that expected to continue? And I know that's not an easy question to address, but nevertheless, we'll try and pick your brains on that.
Yeah, in some ways, the reason I chose that case study earlier, that value versus growth case study, because I know that delineation in India isn't that relevant, but it is relevant to this because it's been one of the key reasons why you've seen our performance in the United States for the last 7 years. And I just thought it was very important to break down what has driven that outperformance by some of the big companies in the US. It's been strong fundamentals. But it hasn't just been that. It's been multiple expansion as well. And that multiple expansion has come about in a time where we've had loose monetary policy. We've had all these tailwinds supporting US equities, particularly in the period leading up to the end of last year. Those tailwinds are now turning into headwinds in some cases. Not all. The fundamentals in the main still are okay. But those strong earnings that had been exhibited by some of the big US companies are now priced in. And for them to just maintain sort of decent returns going forward, you need multiples to stay at those levels. Unfortunately, in a rising rate environment, those elevated multiples come under pressure, and that hits the US. We're seeing that over the course of January.
Right. So net, I would take from that you're saying that the probability of US equities outperforming India over the next few years would probably be on the lower side.
Correct.
I take it, okay.
Correct. But that doesn't mean US equities don't have a place.
Absolutely.
Because at the end of the day, you're trying to, we're trying to balance two things, valuation and diversity.
Correct.
And US equities do provide that diversity.
Absolutely, no doubt. And so there's another question, which is, slightly from a macro kind of a perspective that, do you see, the Fed, doing something like what, Paul Volcker had done, I think in the late 70s, early 80s, where inflation was very high, by quick sort of, rate hikes over the next few months to curb inflation. So do you see that kind of a situation sort of repeat in the US?
Look, that is a fantastic question. I really like that question, Dhaval. Thank you. Mm-hmm. I mean, this is the topic of the day, isn't it? Really, with what we saw last night coming through from the US and the comments that were made in response to those. So what we have right now is a situation where there's around an 80% probability of a 50 basis point increase in rates at the March meeting. And that was in response to that inflation print last night. Now, and then further rate rises thereafter. To answer the question, we don't know. What I expect is that the Fed will be data-driven. The problem is right now is that the data is saying the economy and inflation is overheating. And that's what the market's starting to react to. Now, the problem is that there is the possibility for a huge misstep, from the Fed. There's a possibility that they just get it wrong. They tighten too quickly. They exactly have that scenario you spoke of, or they don't tighten quickly enough and inflation gets out of hand. So it's going to be very tricky for the Fed. However, we actually from an investing perspective, this is a good thing because I'd expect the potential for volatility to be quite high as the market and the Fed overall underreact to data and as it comes through. You know, if they, for example, raise too quickly and then need to move back or vice versa, the volatility in markets will likely increase. And with that volatility, it'll provide an opportunity to move into assets, you know, at prices that are closer to their fair value. The key for us will be to understand the fair value. And this high volatility in the markets is a wonderful, wonderful thing. And so the short answer is, I kind of hope there is, we don't hope for a misstep, but we hope for volatility.
And, you know, a couple of questions around Chinese equities. Obviously, you mentioned a little bit, you know, when you were going through the slides in terms of our views. But can you know, talk a little bit more about, and specifically, you know, there are questions around, you know, what sort of percentage allocation would you suggest for Chinese markets now, or you know, things around, you know, the regulatory environment out there. Again, you know, do you see, you know, further concerns around, you know, regulations in China? So essentially, two parts to it. One is, you know, do you see the regulatory environment worsening? And secondly, you know, based on the views that we spoke of a little bit earlier, is that what sort of allocation would you suggest for, you know, Chinese equities?
In terms of the specific exposure, it's going to depend on the portfolio and its risk profile. And so from an Indian portfolio perspective, that's different to an Australian portfolio or a US portfolio perspective. The one thing we talk about constantly when it comes to Chinese equities, or when it comes to any asset that has fundamental risk attached to it, is what is the fundamental threshold. No matter how cheap it gets, what is the most that you would invest? And that's going to depend on your individual risk profile, the risk profile of the product. But that is the key question to answer, because as you see prices falling and an asset becoming more appealing, there needs to be a maximum exposure in portfolios, and that maximum exposure will depend on your risk preference and profile. You know, from an Indian portfolio perspective, very much also depends on the benchmark and the exposure to the benchmark to Chinese equities. But so that's one of the sort of, you know, upper bounds when it comes to China. In Australia, we discuss this all the time. What is the most that we are willing to invest? And we had the same discussion on energy as well over the last 24 months, because these assets under certain scenarios are very risky. And so therefore you want to control the total portfolio risk no matter how attractive it is. That's a great question, but unfortunately the answer depends on the portfolio. Regulatory pressure? Regulatory pressure is something too that is driving this uncertainty. And you know, that's been sort of the subject of the fundamental reviews that we've been undertaking within China. We want to effectively take a haircut to the cash flows, and then after applying that haircut, look at where the valuation is compared to the price. What we know is that the price for Chinese equities has fallen quite materially over the last 12 months. At the same time, that regulatory risk has increased. You know, profitability does have the potential to be curbed, but nonetheless, some of the businesses in China are very, very attractive nonetheless, and big, you know, big companies with strong cash flows and growth profiles that make them appealing despite the higher regulatory risk going forward.
Fair enough. You know, a couple of quick questions maybe to round off is that one is, you know, again, you spoke of some of these briefly, but I think, you know, people may want to hear a little bit more about, you know, the view, say, on Asian bonds, on US technology, you know, sector as US technology as a sector, and, you know, US income funds. I assume that's around US, you know, debt as such. So three broad areas: Asian bonds, you know, US technology, and US fixed income.
And US fixed income. So in terms of the Asian bonds, you know, EMD, emerging market debt, it's one of the standouts in terms of our fixed income opportunity set at the moment. Now, Indian long-term debt too is very attractive. You've got this wonderfully steep yield curve. That's very, very, very valuable. It's wonderful for banks, ultimately for profitability for banks. You don't have that. We don't have that at the moment in in US bonds. We're seeing the curve flatten in response to what people are thinking with regards to the Fed and how bonds are going to evolve. Now, that flat yield curve is not good for bank profitability. And so there's implications for equities, implications for fixed income, but certainly within fixed income markets, we've got some disparity with EM and Indian bonds at the long end much more attractive than other areas. When it comes to stock markets, like tech, when it comes to the tech sector, like bonds unfortunately are related to that as well in terms of the multiples and the operating performance. Firstly, has been strong, from companies like Apple, no doubt, but also the facts are that the multiples at which some tech companies have been trading at have been high as a consequence of low bond yields, and that's in time will come under pressure. So we have a situation today where bond yields in the US are 10 years are 2%. It's ultimately a question of where those land and what it ultimately does to multiples. But we think the pressure beyond multiples will be down, and that will affect so-called long duration more than short duration assets.
Fair enough. And I think one last question, at least for the moment, is around gold. So what is your view on gold? In fact, I'll try and combine two of them, view on gold, and somebody's also asked about view on crypto, as an asset class. So any thoughts around the two of them?
Yeah, look, I'll start with crypto.
Yeah.
We are not, as you know, Dhaval, we are not drawn to these assets at this time. Crypto, it's not a great medium of exchange because of its volatility. It's not a great store of wealth in a rising rate scenario. Just like we've seen over the course of this year, we've seen what has happened, or what happened to Bitcoin, for example, throughout January. The other thing we'd say is that there's been massive price growth, and that over the last 3 years, and that's another alarm bell. But the thing that is most concerning when it comes to crypto is that the supply demand piece. It's super interesting. In many ways, I would say that the main purpose and attraction of crypto is for speculation. So what you have is a situation where the demand for Bitcoin goes up when the price goes up. The demand goes up when the price goes up, and vice versa. And that's typical of speculative hypes, and that's not the sort of asset that we like to invest in whatsoever. And gold. So gold is we sort of touched on this. It has some attractive characteristics, no doubt. Now, we just think that buying US dollars, buying equities is probably a better way to get fundamental diversity. But in terms of gold right now, it's a very interesting juncture with all these conflicting forces affecting it. And in the long term, in all likelihood, gold's valuation will be driven by real yields. What we saw for real yields in the US is they got highly negative over the last couple of years. And more recently, real yields have started to increase. And when that happens, it means gold valuations, or gold becomes less valuable. There's been this huge correlation between real yields and gold prices over the long term. So the point to watch here are real yields, and they've been rising, and that makes gold less valuable. So that's what I'd say on gold, Dhaval.
Thanks a lot, James. I think that's all that we have, in terms of questions. And so I think, thanks for sharing all your perspective. I think it's definitely been useful for, I would assume it's useful for the audience. In fact, we'll try and get feedback as well. Abhinav, do we want to bring up the survey?
Hi, Dhaval. So once the webinar ends, the survey link will automatically be pushed to the participants.
Okay, fair enough. So just request everybody to hold on for a couple of minutes. We would definitely like to hear your feedback, on the webinar today. And just before we close out, thanks James again for joining us and sort of sharing your thoughts. I think it was pretty comprehensive and useful for the audience, I would like to believe. And I do understand it's pretty late in the evening in Australia right now, so appreciate you taking out time to talk to us today. So
well, thanks very much, Dhaval. It was wonderful to be here. Thanks for the chance to talk to you.
Sure. And thanks to everybody for joining in. I think I hope you found this webinar useful for yourself. Thank you.